Hi, my name is CH. I have worked as a managed investments product specialist in Singapore for over 15 years and would like to offer, through short video courses, the investments related knowledge that I have picked up throughout the years to anyone who is keen to learn more about investments. This video is part of a series of videos focusing on providing basic yet detailed knowledge on mutual funds for Singapore-based or Singapore-booked investors. This is the second video in a series of videos where we aim to go through the different strategy types of mutual funds. In this video, we will give an overview on bond funds. Bond funds, also commonly termed fixed income funds, are mutual funds that invest in fixed and floating rate bonds. They are generally subcategorized in accordance to the different subsegments of the bond universe, which are sovereign or government bond funds that focuses only on bonds issued by countries. Investment-grade bond funds that focuses on high-grade corporate bonds that have a credit rating of BBB- or better. High-yield bond funds that focuses on non-investment-grade corporate bonds that have a credit rating of BB or worse, which generally gives relatively high coupons or yields for the additional risk taken. Floating rate and senior loan funds that focuses on floating rate credits that have coupons directly correlated with interest rates. Financial bond funds that focuses on bonds issued by financial institutions, such as banks, that come with special clauses and features in exchange for higher coupons. Also very common are flexible or diversified bond funds that can invest across all other sub-segments to provide a one-stop solution for bond market exposure. Finally, there is also a special category called fixed maturity bond funds or fixed maturity products, in short FMP, that are diversified bond funds with a predefined maturity date, after which the fund will terminate and return the proceeds back to investors like a normal bond. These are further sliced by geographic exposures, resulting in a wide variety of different types of bond funds catering to different investor needs. For example, a US investment grade bond fund, or an Asian high yield bond fund, or a global flexible bond fund. Investor documents for bond funds are quite different from those for equity funds. Bond funds will provide bond-specific statistics of their portfolios in the documents for investors to better understand the construct and measurements of the underlying investments. Common statistics seen are credit rating breakdown, maturity breakdown, yield to maturity or YTM, yield to worst or YTW, average duration, and more. These information allow bond-focused investors to better understand the funds and also allows them to more easily compare with statistics of direct bonds. Bond funds typically hold hundreds, if not thousands, of positions in their portfolio for better diversification, and also because each bond has a size limit when issued, so they are not as readily available for trading like equities. As such, looking at top 10 holdings in bond fund fact sheets generally is not too useful. Bond funds, just like normal bond investors, will trade in the over-the-counter secondary market as well as participate in bond IPOs to get new bonds. Each bond issue typically requires at least $200,000 to trade, so it is difficult for a non-institutional investor to build a well-diversified bond portfolio using direct bonds. Bond funds and bond ETFs provide an easy solution in this case, where any investor can access different parts of the bond markets in a cost-efficient manner that comes with well-diversification. This is one of the key reasons why bond funds and bond ETFs are popular. Most bond funds also offer a wide variety of currency share classes, in both hedged and unhedged options, to allow investors of different countries to easily invest in bonds of another country. For example, a Singapore investor can invest in a Europe sovereign bond fund with Sing dollar hedge share class so that he doesn't need to worry about FX risk. Bond ETFs do not have as many currency options, so this is one of the advantageous features of bond funds. Many bond investors are income driven. Therefore, most bond funds offer both accumulation and distribution share classes. It is important to note that bond funds are equity companies that invest in bonds. So a bond fund receives all the coupons generated from the underlying bond investments in its portfolio on different dates and pulls them back into the portfolio as part of the overall fund NAV. Separately, the fund determines when and how frequent it should distribute income, and also decide how much to pay out. This basically means that, just like companies do not pay out all their revenue as dividends, a bond fund does not necessarily pay out all the coupons received as distributions to investors. Additionally, in order to provide a more stable income experience for investors, most bond funds offer a smoothened and more frequent distribution payout that does not match the coupon received dates. For example, if a fund has a portfolio that is expected to generate 3.2% yield in the next 12 months, it may set a 3% distribution payable on monthly frequency, so that investors can get around the same distribution amounts every month. In months where the fund receives more coupons, it will keep the excess income in the NAV. Conversely, in months where the fund receives less or no coupons, it will deduct the required amount from the NAV to facilitate the payout. Setting the distribution rate slightly lower than the expected portfolio yield gives some leeway for the fund manager to react to unforeseen circumstances. That being said, some bond funds do provide share classes with distribution rates higher than the expected portfolio yield in order to attract investors that are hungry for high income sources. Such high distribution rates are not sustainable by natural coupons from the underlying holdings, so the fund will need to further reduce the portfolio holdings to compensate for the high distribution. This is directly reflected as a decline in the fund NAV, assuming there is no change to the valuation of the holdings. All is well if such a fund has a healthy subscription flow that helps to grow the portfolio to offset the NAV decline. If, however, the fund doesn't receive enough inflows, the declining NAV would mean that a shrinking portfolio that will in turn negatively impact the future distributions. It may also ultimately end up in a vicious down cycle until the fund becomes too small in size and is forced to close down. So what this means is that while bond funds provide comprehensive portfolio yield statistics to investors, these statistics often have no direct correlation to the distribution rate provided by the funds. Therefore, when assessing performances of bond funds, it is important to look at the ability of the fund to maintain the distribution rate. Distribution should be sustainable. The total net return, which include the NAV return plus the distributions. Having a higher distribution rate does not mean that a fund is doing better than others. Bond investors often dabble into interest rates and currencies, as these financial aspects are closely linked and influences each other. As such, all bond fund managers conduct thorough research and takes views on interest rate and currency movements. And some of these fund managers eventually deploy these views into their funds as an active strategy to generate returns. These funds sometimes end up behaving more like a hedge fund that focuses on credit and FX macro strategies instead of traditional bond funds. Hence, the returns and risks involved become quite different. Investors should take note when reviewing a bond fund to understand where the main sources of return comes from and decide if this is what they are looking for. Defaults in a fund's underlying portfolio holdings is always undesirable, and bond funds often have a harder time handling defaulting or defaulted positions than equity funds. If a bond fund encounters a default situation for a bond in its portfolio, the fund manager needs to decide whether to try to get rid of the position by attempting to sell it to a distressed bond buyer at very low valuations, or to hold on to it and go through the default and restructuring process of the bond, in hopes that the bond price will eventually recover to a slightly higher value. The default and restructuring process of bonds tend to take a long time of months and maybe years. So if the fund manager decides to hold on, this small exposure in the portfolio becomes an illiquid position, as it cannot be adjusted. The longer the restructuring process drags on, the higher the negative impact to the fund performance, as the fund manager cannot reinvest this exposure into other better opportunities. Bond funds that invest into markets with higher volatility and higher uncertainty obviously take a much higher risk of getting more default scenarios in their portfolios. For example, in recent years, many Asia and China bond funds with China real estate exposure suffered large negative performance as the China real estate market collapsed and many real estate firms defaulted on their bonds. Investors should be aware that high risk comes along with high returns in bond funds, and the riskier bond funds can potentially lose as much money as equities. When there are too many defaulted and illiquid positions in a bond fund portfolio, the fund manager needs to take emergency actions as the performance impact becomes significant. Some bond funds resort to an approach that is more common in the hedge funds world, that separates out the so-called bad positions into a separate portfolio as a special share class called side pocket. How this works is that the investor receives an additional investment that is the side pocket share class carved out from the original fund. This new share class is illiquid, which means the investor is unable to redeem to exit it. Instead, the investor has to hold on to it until all the underlying bad positions have been exited, where then the share class will automatically be terminated. The fund is obliged to find an optimal approach to progressively exit the bad positions and return the proceeds in batches to the investors as a capital distribution from the side pocket share class. Now, as mentioned before, it can take a long time for a bond restructuring process or to find a suitable distressed bond buyer. So the investor potentially has no choice but to hold on to this share class. In short, the fund has basically transferred the illiquidity problem to the investor, which is not ideal. Therefore, again, do take note when investing in riskier bond funds. Hopefully, this video has provided you an overview on bond funds, including their subcategories, characteristics, and distribution and return features. This concludes this video. Do check out my other videos to find out and learn more about mutual funds. If you find this video useful and would like to see more related contents, please click on like and subscribe to the channel, as well as share this video to someone else that might find this useful too. Last but not least, if you spot any mistakes or inaccurate information in this video, or have any suggestions to help improve this video, please do drop a comment below. Thank you and have a great day.